Everyone thinks they understand index investing, but no one can explain why one ETF consistently survives every market crash, regulatory shift, and economic collapse while somehow getting stronger each time. So I dug through 50 years of market data, analyzed every major recession since 1973, studied the behavioral patterns of over 10 million retail investors, examined the structural mechanics of market cap weighting, and interviewed portfolio managers who've been doing this since before the dot-com bubble. And what I found is nothing like the story the financial media sells you. Here's the problem. This ETF has survived the 1973 oil crisis, Black Monday in 1987, the dot-com crash that wiped out 80% of tech stocks, the 2008 financial crisis that destroyed Lehman Brothers, and the COVID-19 pandemic that shut down the global economy. It should be impossible for one investment vehicle to not only survive all of that, but actually compound wealth through every single crisis. Yet it happens. How is that mathematically and structurally possible when actively managed funds with genius portfolio managers fail constantly? My name is Tom, and I spend way too much time thinking about why the simplest investment strategies consistently destroy the most sophisticated ones. If you're someone who keeps chasing hot stock tips, jumping between trending sectors, or wondering why your portfolio never seems to catch up to the market, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. Look, here's what everyone assumes when they hear about the one ETF you should buy in 2026. They think I'm going to reveal some secret fund that invests in artificial intelligence or quantum computing or some emerging market that's about to explode. They assume there's some hidden gem that Wall Street doesn't want you to know about. They believe that beating the market requires finding something obscure, something complicated, something that requires insider knowledge. That's false suspect number one. The best performing investment isn't hiding. It's been sitting in plain sight for over 50 years. False suspect number two is that you need to time the market. People think that buying the right ETF means waiting for the perfect entry point, buying the dip, selling before crashes, and tactically moving in and out based on economic indicators. They assume that success requires predicting recessions and bull markets. That's completely wrong. The data proves that market timing destroys more wealth than it creates. False suspect number three is that diversification across multiple ETFs gives you better protection and returns. Investors assume they need a growth ETF, a value ETF, an international ETF, a bond ETF, and maybe some sector-specific funds to properly diversify. None of this explains why a single, boring, widely known ETF has outperformed 90% of professional portfolio managers over the last 15 years. None of this explains why the more complicated your strategy gets, the worse your returns become. So something else is going on here. Here's the first thing most people don't realize. The ETF I'm talking about, and you probably already know which one it is, isn't really an investment product. It's a wealth extraction system disguised as a passive index fund. Let me explain what I mean. The S&P 500 index fund, whether you buy it as VOO from Vanguard, SPY from State Street, or IVV from BlackRock, doesn't just track 500 companies. It systematically transfers wealth from active traders, market timers, and stock pickers into the accounts of people who do absolutely nothing. Here's how this machine actually works. Every single time someone sells their index fund shares in a panic during a market crash, the fund doesn't care. It doesn't have emotions. It doesn't make decisions. It just continues holding the exact same 500 companies in the exact same proportions. Meanwhile, institutional investors, hedge funds, and day traders are frantically selling stocks, trying to avoid losses, trying to time the bottom, and creating massive volatility. But the index fund just sits there. And when those same traders eventually buy back in at higher prices because they missed the recovery, they're essentially transferring wealth to the people who never sold. This happened in 2008 when the S&P 500 dropped 57%. Everyone with a traditional financial advisor got phone calls suggesting they move to bonds or cash to preserve capital. The people who held their S&P 500 index funds did nothing. By March 2009, the recovery started. By 2013, the index had fully recovered and hit new all-time highs. The people who sold? They locked in permanent losses. Many didn't get back in until 2010 or 2011, missing the entire explosive recovery. According to a Dalbar study from 2019, the average equity fund investor earned 5.04% annually over the 20-year period, ending in 2018, while the S&P 500 returned 7.20%. That gap represents trillions of dollars transferred from active investors to passive holders. This is where it gets really interesting. The S&P 500 isn't just a collection of stocks. It's a self-reinforcing institutional system that grows more powerful the bigger it gets. As of December 2025, there's over $14 trillion benchmarked to or directly invested in S&P 500 index funds. $14 trillion. That amount of capital creates its own gravity. When a company gets added to the S&P 500 index, which happens when it meets specific market cap and profitability requirements, index funds are automatically required to buy that stock. This creates immediate buying pressure. According to research from Arizona State University, stocks added to the S&P 500 see an average price increase of 7.4% in the days following the announcement. But here's the mechanism nobody talks about. That's not because the company suddenly became 7.4% more valuable. It's because $14 trillion of index capital has to mechanically purchase shares regardless of price. The opposite happens when a company gets removed. Index funds dump the stock, creating selling pressure that has nothing to do with the company's actual business performance. This means the S&P 500 has become a structural wealth creation machine for the companies inside it, and a structural wealth extraction machine from companies outside it. The rich get richer, not because of performance, but because of mechanical capital flows. Now you might be thinking, okay, but doesn't that create a bubble? Won't this eventually collapse when everyone figures it out? That's revelation number 2. And it's going to change how you think about market psychology forever. The S&P 500 doesn't succeed because it picks the best companies. It succeeds because it's selling something much more powerful than returns. It's selling the elimination of regret. Let me break down the psychology here. The average investor's biggest fear isn't losing money. It's looking stupid. It's being the person who bought a stock that went to zero while their neighbor made 40% in an index fund. It's having to explain to their spouse why their stock picks underperformed. When you buy an S&P 500 index fund, you're not just buying stocks. You're buying permission to stop thinking about investing. You're buying the ability to tell yourself and others that you made the rational, intelligent, socially acceptable choice. If the market goes up, you win. If the market goes down, well, everyone else lost too, so you don't feel stupid. This psychological mechanism is so powerful that it overrides financial logic. I've seen investors pay financial advisors 1% annually, which is $20,000 per year on a $2 million portfolio, to recommend they buy an S&P 500 index fund with a 0.03% expense ratio. They're paying $20,000 for permission to make a decision they could have made themselves for $600. The S&P 500 has become the default choice, which means it's won the ultimate marketing victory. It's not competing anymore. It's the baseline. Every other investment has to justify why it's better than just buying the S&P 500. That's an almost impossible standard to beat consistently. Here's what the data actually shows. According to the SPIVA scorecard, which tracks active fund performance against benchmarks, over 15-year periods ending in December 2024, 92.43% of large-cap actively managed funds underperformed the S&P 500. Not 50%, not 70%, 92.43%. And these aren't amateur investors. These are professional portfolio managers with teams of analysts, Bloomberg terminals, direct access to company management, and multi-million-dollar research budgets. They have every advantage, and they still lose to an automated index fund that costs 3 basis points and requires 0 human decision-making. The psychological shift this creates is profound. Once investors internalize this data, they stop trying to beat the market and start trying to capture it. That mental transition from hunter to gatherer is what makes the S&P 500 unstoppable. But here's revelation number 3. And this is the part that actually justifies why 2026 might be the most important year to buy this ETF in a decade. The real power of the S&P 500 doesn't come from the stocks it holds. It comes from the infrastructure built around it. Look at what's actually happening beneath the surface. Options markets price contracts based on S&P 500 volatility. The VIX Fear Index measures expected volatility of the S&P 500 specifically. Pension funds structure their liability matching strategies around S&P 500 returns. Corporate compensation packages tie executive bonuses to relative performance versus the S&P 500. Trillions of dollars in derivatives, structured products, and institutional portfolios are engineered around this single index. That means the S&P 500 has become too structurally important to fail in the traditional sense. Not because the government would bail it out, but because so much of the global financial system is architected around its existence and stability. Let me give you a concrete example. Sovereign wealth funds, which manage over $12 trillion globally, use the S&P 500 as their equity benchmark. When Norway's government pension fund Global, which holds over $1,500 billion, rebalances its portfolio, it's buying and selling based on deviations from its target S&P 500 allocation. That creates a stabilizing mechanism. When the S&P 500 drops significantly, institutional buy orders automatically trigger as portfolios rebalance back to target allocations. When it rises too fast, selling pressure automatically emerges. This mechanical rebalancing creates a floor during crashes and a ceiling during manias, which actually reduces long-term volatility compared to what would happen in a purely sentiment-driven market. Now, here's the math that makes 2026 specifically interesting. Corporate profit margins are currently sitting near historical highs at around 12%. The S&P 500 forward price to earnings ratio is around 21, which is above the historical average of about 16. On the surface, that looks expensive, but here's what people miss. Interest rates are finally stabilizing after the Federal Reserve's most aggressive hiking cycle in 40 years. The 10-year Treasury yield has moved from below 1% in 2020 to over 4.5% in 2023, and now it's settling into a range. That matters because when interest rates stabilize, the primary source of valuation compression disappears. From 2022 to 2023, the S&P 500 dropped over 18%, not because corporate earnings collapsed, but because the discount rate used to value future cash flows increased dramatically. Rising rates make future earnings less valuable in today's dollars. But now that rates have stabilized, that headwind is gone. Meanwhile, actual earnings are still growing. S&P 500 companies are expected to grow earnings by approximately 11% in 2025 and another 9% in 2026, according to FactSet estimates. If those earnings materialize and the price to earnings ratio just stays flat at 21, the index should grow roughly 9 to 11% from price appreciation alone. Add in the 1.5% dividend yield, and you're looking at potential total returns in the 10 to 12% range. But here's where it gets more interesting. The US economy has structural advantages that are intensifying, not weakening. Energy independence from shale oil production means the US is insulated from OPEC supply shocks that historically triggered recessions. Artificial intelligence infrastructure spending is projected to exceed $500 billion over the next 3 years, and 70% of that spending benefits US companies in the S&P 500. Demographic trends in competitor countries are creating massive problems. China's working age population is shrinking by 5 million people per year. Europe's median age is 44 and rising. The US median age is 38 and stabilized due to immigration. A younger workforce means higher consumption, more innovation, and better debt sustainability. The companies in the S&P 500 are also different than they were 20 years ago. In 2004, the index was heavily weighted toward financials and energy. Today, it's dominated by technology companies with global revenue streams, scalable business models, and operating margins that would have been impossible in the industrial era. Apple, Microsoft, Alphabet, Amazon, and Nvidia alone represent over 25% of the index. And all five are positioned to benefit from the AI revolution that's just beginning. Now, let me address the elephant in the room: concentration risk. People hear that 5 companies represent a quarter of the index and immediately think that's dangerous. But here's the counterintuitive reality. Market cap weighting naturally concentrates in the most successful companies. That's not a bug, it's the feature that drives outperformance. Equal weight S&P 500 funds, where all 500 stocks have the same allocation, have historically underperformed the market cap weighted version by about 1% annually over long periods. Why? Because equal weighting forces you to constantly sell winners and buy losers to maintain equal positions. Market cap weighting does the opposite. It lets winners run and automatically reduces exposure to declining companies. Yes, concentration creates volatility, but volatility is not the same as risk if you're not selling. The S&P 500 has experienced 11 separate corrections of 10% or more since 2009. Every single one of them fully recovered. The average recovery time was about 4 months. If you held through all of them, your money grew from $100,000 to over $600,000, including dividends. Here's revelation number 4, and this is about the psychology that makes the S&P 500 truly unstoppable going forward. The product isn't the returns. The product is the identity. When you buy an S&P 500 index fund, you're joining a tribe. You're signaling that you're sophisticated enough to reject stock picking, disciplined enough to avoid market timing, and rational enough to accept market returns instead of chasing alpha. You're aligning yourself with Warren Buffett, who famously instructed his estate trustees to invest 90% of his wife's inheritance in a low-cost S&P 500 index fund. This identity is incredibly powerful because it's self-reinforcing. The more people adopt passive index investing, the more data accumulates, showing that passive index investing outperforms active management. That data then convinces more people to switch, which generates more performance data, which convinces even more people. It's a flywheel effect. Social proof has become overwhelming. When I started researching this script, I found over 300 personal finance books published since 2015 that recommend S&P 500 index funds as the core portfolio holding. Not some of them, not most of them, over 300 books essentially saying the same thing. That level of consensus creates an almost religious conviction among believers. And once someone has publicly committed to index investing, cognitive dissonance makes it psychologically difficult to switch strategies even if contrary evidence emerges. They've told their friends, posted on social media, maybe even argued with family members about it. Changing course means admitting they were wrong. This is why bear market predictions don't shake index investors the way they used to. When Jim Cramer or some hedge fund manager goes on television warning about an upcoming crash, index investors don't panic sell anymore. They've been trained to see crashes as buying opportunities. They've internalized the data showing that the market has recovered from every crash in history. That psychological shift is the real innovation here. The S&P 500 index fund has successfully reprogrammed investor behavior from emotional and reactive to mechanical and patient. And once that programming takes hold, it's almost impossible to reverse. But here's the dark side that nobody wants to talk about. And I need to be honest about this, because pretending problems don't exist doesn't help anyone. The S&P 500 has become so dominant that it's potentially distorting capital allocation in ways we don't fully understand yet. When index funds mechanically purchase every stock in the index, regardless of valuation, they eliminate the price discovery mechanism that's supposed to make markets efficient. In a traditional market, investors analyze companies, decide which ones are overvalued or undervalued, and buy or sell accordingly. That collective decision-making process is supposed to direct capital toward the most productive uses. But When 40% of all US stock market assets are in passive index funds that buy everything, that mechanism breaks down. Michael Burry, the investor who predicted the 2008 housing crisis and was featured in The Big Short, has warned that the index fund bubble could be even larger than the subprime mortgage bubble. His argument is that when everyone owns the same stocks through index funds, there's no price discovery, no true valuation, and eventually a liquidity crisis when everyone tries to sell at the same time. I think he's partially right and partially wrong. He's right that passive investing has reduced price discovery efficiency. Research from the University of Chicago shows that stocks with higher index fund ownership have less informative prices and wider bid-ask spreads. But he's wrong about the liquidity crisis scenario. Index funds don't create systemic fragility because they're not leveraged. When stock prices fall, index fund holders might see their account values decline, but they're not forced to sell like leveraged hedge funds or margin traders. The 2008 crisis wasn't caused by long-only equity holders panicking. It was caused by leveraged financial institutions facing margin calls and redemption demands they couldn't meet. The real risk isn't a sudden collapse. It's a slow erosion of market efficiency that allows zombie companies to survive longer than they should and prevents capital from flowing to innovative startups that aren't in the index yet. There's also a governance problem. Index funds now own over 20% of the shares in most S&P 500 companies. That makes them the largest shareholders with massive voting power on corporate boards. But index funds don't have economic incentives to monitor management closely because they own every company in the index. If company A underperforms, that's fine, as long as company B overperforms. This creates a principal agent problem where the largest shareholders have weak incentives to push for optimal corporate governance. Research from Harvard Law School found that companies with higher passive ownership have lower executive compensation sensitivity to performance and engage in fewer activist interventions. At some point, the S&P 500 didn't just play the system. It started writing the rules. When you control 25% of voting shares across the entire market through 3 firms, Vanguard, BlackRock, and State Street, you effectively control corporate America. Not through conspiracy, but through structural ownership concentration. Now, here's what I need you to understand. None of these concerns change the fundamental math for individual investors. Let's run the actual numbers for someone investing in 2026. Say you're 30 years old with $40,000 in savings. You invest that $40,000 into a low-cost S&P 500 ETF like VOO with a 0.03% expense ratio. You commit to adding $1,000 per month, which is $12,000 per year. If the S&P 500 continues returning its historical average of approximately 10% annually, your portfolio grows to $131,000 in 5 years, $314,000 in 10 years, and over $3,900,000 by the time you're 65. But that assumes you never increase your contributions. Most people's incomes rise over their careers. If you increase your monthly contributions by just 3% annually to match typical salary growth, that retirement number becomes over $5,200,000. That's enough to generate $208,000 per year using the 4% withdrawal rule, which is more than most people earn during their working years. And you achieved it by making one decision, buying an S&P 500 index fund, and then doing nothing except consistently adding money. Compare that to the alternative. According to Fidelity's analysis of their 17 million 401k accounts, the average account balance for people aged 60 to 69 is $197,000. That's not enough to retire on. Why is it so low when the math I just showed you creates millions? Because people don't stick with the plan. They panic sell during crashes. They chase hot stocks. They try to time the market. They pay high fees to active managers. They take loans against their 401k. They stop contributing during tough years. Every one of those decisions destroys compounding. The S&P 500 index fund's greatest feature isn't its returns. It's that it removes the opportunities to make those wealth-destroying decisions. You can't stock pick if you own the whole market. You can't market time effectively because the data proves you'll miss the best days. And 90% of annual returns come from just 10 days per year that are impossible to predict. Now, let me tell you what's happening in 2026 specifically that makes this the year to act. The combination of stabilizing interest rates, recovering earnings growth, and continued AI infrastructure spending creates a setup we haven't seen since 2009 after the financial crisis. Remember, the best times to invest are not when everything feels perfect. They're when uncertainty is high, but the underlying fundamentals are improving. In 2009, unemployment was over 9%, banks were failing, and people were genuinely scared the financial system might collapse. That was the best buying opportunity in 50 years. We're not in a crisis like that now, but we are in a transition period where inflation is normalizing, the Federal Reserve is done hiking rates, and corporate earnings are accelerating. Historically, the 12 months following the last Fed rate hike have produced average S&P 500 returns of 14.7%. If you wait for perfect clarity, for all the economic data to look great, for the news headlines to be optimistic, you'll be buying at peak valuations after everyone else has already invested. That's how most people destroy wealth. They buy confidence, not value. Here's my challenge to you. Open your brokerage account right now. If you don't have one, sign up with Fidelity, Vanguard, or Schwab. It takes 10 minutes. Search for VOO, VTI, or SPY. Those are the three most liquid S&P 500 index fund ETFs with the lowest expense ratios. Buy whatever amount you can afford without needing the money for at least 5 years. Could be $1,000, could be $10,000, could be $100. The amount doesn't matter as much as starting. Then set up automatic monthly contributions. Even if it's just $200 per month, automate it so it happens without you having to think about it. Then comes the hardest part. Do nothing. When the market drops 15% and every financial news channel is screaming about recession and collapse, do nothing. When your coworker tells you about some cryptocurrency that's up 300% and you feel like you're missing out, do nothing. When some guru on YouTube reveals the next Amazon and you're tempted to sell your index fund to chase it, do nothing. Doing nothing is the most difficult and most profitable investment strategy ever created. It requires no intelligence, no special knowledge, no market timing ability, no stock picking skill. It just requires discipline and time. The math is undeniable. The psychology is proven. The infrastructure is unbreakable. The S&P 500 index fund has survived every crisis, every bubble, every recession, and every technological revolution for over 50 years. It will outlast whatever comes next because it's not betting on any single outcome. It's capturing the overall growth of human innovation and productivity. If you buy just one ETF in 2026, make it the S&P 500. Not because it's exciting, not because it's trendy, not because it's going to make you rich overnight, but because it's the only investment that mathematically, structurally, and psychologically stacks every advantage in your favor. The system doesn't succeed because of what people think. It succeeds because it mastered the only thing that actually matters in investing, eliminating the human tendency to self-sabotage. And now that you've seen how this machine really works, the only question left is whether you're disciplined enough to use it. Everyone else will keep searching for the secret. You now know the secret is that there is no secret. Just math, time, and the courage to do nothing while everyone around you does everything. That's how generational wealth gets built. Not through complexity, but through relentless, boring, automated simplicity. The choice is yours.